Picture this. It's a random Tuesday morning. You're 52 years old, sitting in your kitchen with your coffee, and you open your investment app out of habit. The number on the screen stops you cold. $1 million. You blink. Refresh the page. Still there. $1 million that you barely had to think about. No lottery ticket, no inheritance, no risky crypto gamble. Just $500 a month for 27 years, sitting in an S&P 500 index fund, doing absolutely nothing except existing. And now you're a millionaire. I'm Max, and today we're breaking down exactly how investing just $500 a month can completely transform your entire financial reality. Not through some get-rich-quick scheme, not through day trading or picking stocks or timing the market, through the most boring, predictable, reliable wealth-building strategy that exists. Buying an S&P 500 index fund every single month and never touching it. That's it. That's the whole strategy, and by the end of this video, you'll understand exactly why this simple approach has created more millionaires than almost any other investment strategy in history. We're going to run the actual numbers, show you what your account looks like after 10 years, 20 years, 30 years. Break down why the S&P 500 is the most powerful wealth-building tool available to regular people. And explain why, starting this month, not next year, not when you get that raise, not when conditions are perfect, but right now is the difference between retiring wealthy and working until you're 75. Let's get into it. The magic of the S&P 500. Let's start with the foundation. What the hell is the S&P 500? And why does it matter? The S&P 500 is an index of the 500 largest publicly traded companies in America. We're talking Apple, Microsoft, Amazon, Google, Tesla, Nvidia, Walmart, Coca-Cola. The biggest, most profitable, most dominant companies on the planet. When you invest in an S&P 500 index fund, you're buying tiny pieces of all 500 companies at once. And here's the beautiful part. You don't have to pick which companies will succeed. You don't have to analyze balance sheets or predict the future or read earnings reports. You just own a piece of American capitalism. And over time, American capitalism goes up. Not every day, not every year, but over long periods it goes up. Consistently, predictably, powerfully. The historical average annual return of the S&P 500 is about 10%. Some years it's up 30%. Other years it's down 20%. But average it all out over decades and you get roughly 10% per year. That might not sound exciting. It's not going to make you rich overnight. But compound that 10% over 20 or 30 years and the numbers become absolutely insane. And the best part? You don't have to do anything. You're not actively managing this. You're not watching charts. You're not stressing about whether to buy or sell. You just set up automatic monthly. Investments and the S&P 500 does all the heavy lifting. The companies in the index are constantly innovating, expanding, generating profits, returning value to shareholders, and you get to capture all of that growth without lifting a finger. This is passive investing at its finest. You're leveraging the collective intelligence, work ethic, and innovation of thousands of the smartest business minds in the world. You're betting on human progress, on technological advancement, on the fact that companies will continue finding ways to create value and generate profits. And historically, that bet has paid off spectacularly. The real numbers. What $500 a month actually becomes. Alright, let's get into the actual math, because this is where it gets wild. You invest $500 per month into an S&P 500 index fund every single month, no matter what the market is doing. Bear market, bull market, doesn't matter. You just keep investing. Here's what happens. After 1 year, you've invested $6,000. With 10% average returns, your account is worth about $6,600. You made $600. That's not life-changing. That's a nice dinner or a weekend trip. Nothing to get excited about yet. After 5 years, you've invested $30,000 total. Your account is now worth approximately $38,700. You've made $8,700 in gains. Okay, that's better. That's real money. But you're still not wealthy. You're still grinding at your job, still living a normal life. After 10 years, you've put in $60,000 of your own money. But your account isn't worth $60,000. It's worth $102,000. You've gained $42,000 just from the market doing its thing. Now we're starting to see the power. Your money made 42 grand while you slept, worked, lived your life. That's almost a year's salary for some people, and you didn't have to work for it. After 15 years, you've invested $90,000 total. Your portfolio is worth $209,000. You've gained $119,000. Your gains now exceed your total contributions. Think about that. The market has given you more money than you put in, and it's accelerating. After 20 years, you've contributed $120,000. Your account is worth $382,000. You've made $262,000 in pure profit. You're watching your net worth increase by $30,000, $40,000, $50,000 per year without you doing anything except staying invested. After 25 years, you've invested $150,000. Your portfolio is worth $662,000. You've gained $512,000. You're 2/3 of the way to being a millionaire, and you're watching it happen in real time. After 27 years, you've put in $162,000. Your account hits $1 million. You're a millionaire. You did it by investing $500 a month and doing absolutely nothing else. No stock picking, no market timing, no complicated strategies. Just consistent monthly investments in the S&P 500 for 27 years. But let's keep going, because this is where it gets truly insane. After 30 years, you've invested $180,000 total. Your portfolio is worth $1.2 million. After 35 years with the same $500 monthly investment, you're sitting on $1.9 million. After 40 years, $2.9 million. Nearly $3 million from investing $500 a month. Let me say that again. Invest $500 per month for 40 years, and you retire with almost $3 million. You will have contributed $240,000 of your own money over those 40 years. The other $2.6 million, that's compound interest. That's the market working for you. That's the S&P 500 quietly building generational wealth while you live your life. Why this strategy beats almost everything else. Now you might be thinking, okay, those numbers sound great, but why the S&P 500 specifically? Why not individual stocks? Why not crypto? Why not real estate? Let me break down why this passive index investing approach beats almost every other strategy for regular people. First, it requires zero expertise. You don't need to understand financial statements. You don't need to predict which companies will succeed. You don't need an MBA or a finance degree. You literally just need to know how to set up automatic monthly transfers. A teenager could do this, and in fact, teenagers who start doing this will end up richer than most adults who spend decades trying to pick winning stocks. Second, it's incredibly tax efficient. You're not constantly buying and selling, which means you're not triggering capital gains taxes every year. You buy and hold. Your money compounds tax-free until you eventually sell decades from now. Compare that to day traders who are paying short-term capital gains taxes on every profitable trade. They're getting destroyed by taxes while you're keeping every dollar of growth. Third, the fees are microscopic. A good S&P 500 index fund charges like 0.03% per year in fees. That's $3 per year for every $10,000 you have invested. Meanwhile, actively managed funds charge 1 to 2% per year. That difference might not sound like much, but over 30 years, high fees can cost you hundreds of thousands of dollars in lost returns. Fourth, it removes all emotion from investing. Emotional decisions destroy wealth. People panic sell during crashes and miss the recovery. They get greedy during bull markets and buy at the top. They chase hot stocks and get burned. With this strategy, you eliminate all of that. You invest the same amount every month regardless of what the market is doing. Market crashes? Great, you're buying shares at a discount. Market ripping higher? Awesome, your existing shares are worth more. You literally cannot lose by staying consistent. Fifth, it's backed by decades of data. The S&P 500 has existed since 1957. We have almost 70 years of historical data showing that this works. Through wars, recessions, pandemics, political chaos, technological revolutions, this index has consistently delivered returns. It survived the 1987 crash, the dot-com bubble, the 2008 financial crisis, the 2020 COVID crash, and every single time it recovered and went on to hit new all-time highs. Sixth, it automatically adapts to the economy. The S&P 500 isn't static. Companies get added and removed based on performance. Failing companies get kicked out. Rising stars get added in, so you're always invested in the strongest, most successful companies without having to do anything. It's a self-cleaning, self-optimizing portfolio. Compare this to trying to pick individual stocks. Studies show that over 90% of active fund managers fail to beat the S&P 500 over long periods. These are professionals with teams of analysts, insider access, sophisticated models, and they still can't beat the index. What makes you think you can? You can't. Nobody can consistently. So why try? Just buy the index and move on with your life. The power of starting early. Now, let's talk about timing because this is crucial. The single most important factor in building wealth through investing isn't how much you invest. It's how long you stay invested. Time is more valuable than money when it comes to compound interest. Let me show you what I mean. Person A starts investing $500 per month at age 25. They do this for 10 years until age 35, then stop completely. They never add another dollar, but they leave that money invested until age 65. Person B waits until age 35 to start investing. They invest $500 per month from age 35 to 65. 30 full years of contributions compared to Person A's 10 years. Who has more money at 65? Person A. Even though they only invested for 10 years and contributed $60,000 total, while Person B invested for 30 years and contributed $180,000 total. Person A ends up with more money. Why? Because those first 10 years of compound growth are worth more than the next 20 years of contributions. Time in the market beats timing the market, and it beats late contributions. This is why starting now, today, this month is so critical. Every year you wait costs you exponentially. If you're 25 and you start investing $500 per month, you'll have $2.9 million by 65. If you wait until you're 30, you'll have $1.9 million. If you wait until 35, you'll have $1.2 million. If you wait until 40, you'll have $663,000. Same monthly investment, massively different outcomes based purely on when you started. And the crazy part? Most people wait. They think they'll start investing when they make more money, when they pay off their car, when they buy a house, when the kids are older, when conditions are perfect, and they wake up at 45 realizing they have almost nothing saved. And now they need to invest $1,500 per month to catch up instead of $500 if they'd started at 25. Stop waiting. Stop making excuses. $500 per month is about $17 a day. That's 2 drinks at Starbucks. That's 1 lunch out. That's a streaming service subscription and a gym membership. You can find $500 per month if you actually want to. And if you can't, start with $300 or $200 or $100. Start with something. Because starting small today beats starting big later. The mistakes that will destroy your returns. Now let me tell you exactly how people screw this up. Because the strategy is simple, but execution is where most people fail. These are the mistakes that will kill your returns and keep you broke even though you're investing. Mistake number 1, stopping during crashes. The market will crash. Guaranteed. Maybe next year, maybe in 5 years, but it will happen. Your portfolio will drop 20, 30, maybe 40%. And your brain will scream at you to sell, to stop investing, to preserve what you have left. This is the moment that separates people who build wealth from people who stay broke. When the market crashes, you do not stop investing. You do not sell. You keep buying. Because crashes are sales. Everything is discounted. You're buying the same companies you were buying before, but now they're 30% cheaper. This is the best time to invest, not the worst. People who kept investing through 2008, through 2020, through every crash, they're the ones who got wealthy. Mistake number 2, trying to time the market. People wait for the perfect entry point. They want to buy at the bottom, so they sit on the sidelines with cash, waiting. And while they wait, the market keeps going up. They miss 6 months of gains, a year, 2 years, and they never find that perfect entry because it doesn't exist. You know what beats trying to time the market? Time in the market. Just invest now and stay invested. Mistake number 3, panic selling after making gains. Your portfolio hits 100,000 and you're feeling great. Then the market drops 10% in a week. Suddenly you're down to 90,000 and you freak out. You sell everything to lock in your gains before they disappear completely. Congratulations, you just destroyed your future wealth. That 10% drop would have recovered in a few months, but you sold, locked in the loss, and now you're sitting in cash while the market recovers without you. Mistake number 4, getting distracted by individual stocks or crypto. You've been investing in the S&P 500 for a few years, building wealth slowly and steadily. Then some stock starts ripping, or Bitcoin goes crazy, or your buddy tells you about some company that's definitely going to the moon, and you think, why am I settling for 10% returns when I could be making 50%? So you pull money out of your index fund and buy the hot stock, and 90% of the time you lose. Because you're not an expert. You don't have insider information. You're just gambling. And even when you win once, you get cocky and bet bigger next time and lose it all. Meanwhile, the S&P 500 just keeps chugging along, making 10% per year, every year, creating millionaires out of people who didn't get distracted. Mistake number 5, not increasing contributions as income grows. You start investing $500 per month at age 25 when you're making $50,000 per year. By age 35, you're making $90,000. By 45, you're making $130,000. But you're still only investing $500 per month because that's what you started with. This is leaving massive amounts of money on the table. As your income grows, your investments should grow. If you're making $130,000 per year, you should be investing at least $1,000 per month, probably more, because you can afford it and because the returns on that extra money will be insane. Going from $500 to $1,000 per month doubles your future wealth. Don't leave that on the table. How to actually start this today. All right, enough theory. Let's talk execution. How do you actually start investing $500 per month in the S&P 500? Here's the exact step-by-step process. Step 1. Open a brokerage account. Vanguard, Fidelity, Schwab, doesn't matter. They're all good. Pick one and open a standard brokerage account. This takes like 10 minutes. You'll need your social security number, bank account info, basic personal information. That's it. Step 2. Set up automatic monthly transfers from your checking account to your brokerage account. $500 on the first of every month or whenever you get paid. Automate this so you never forget. Treat it like a bill. Non-negotiable. Step 3. Set up automatic investments. Most brokerages let you automatically invest your cash into specific funds. Choose an S&P 500 index fund. At Vanguard, it's VOO or VFIAX. At Fidelity, it's FXAIX. At Schwab, it's SWPPX. These are all basically identical. They track the S&P 500, charge minimal fees, and have decades of performance history. Set it to automatically invest all available cash into this fund. So every time money hits your brokerage account, it immediately gets invested. No decisions, no hesitation. Automated wealth building. Step 4. Never look at it. Seriously, check it once a year if you must. But don't obsess over daily movements. Don't check it when the market crashes. Don't watch CNBC. Don't read financial news predicting the next crash. Just let it grow. The more you look, the more likely you are to make an emotional decision that destroys your returns. That's it. 4 steps. Open account, automate transfers, automate investments, ignore it for decades. This is not complicated. A child could do this. But most adults won't because it's boring. It's not exciting. There's no dopamine hit from watching lines go up and down every day. But boring is what builds generational wealth.